The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Thank you for joining us today at our webinar on the Tax Cuts and Jobs Act, tax provisions impacting businesses. This is the second webinar in our series of 4 that we'll be hosting this month. My name is Karen Arta Sanchez, and I'm here with my partner, Len Nitti, and we'll be taking you through our presentation today. So before we get started, there's a few housekeeping items that I'd like to go over. First, please use the questions pane in the GoToWebinar dashboard to submit any questions you may have. We'll try to answer as many of the questions as possible throughout the presentation. However, if we don't get to your question, we will follow up with an email. For those of you interested in CPE or CLE credits, you must stay logged on to the webinar for the entire time, and you must respond to all polling questions throughout the presentation. Additionally, you have to be logged on individually in order to obtain credit. We're unable to provide credits for those of you that may be viewing this webinar as a group. And finally, we're recording this webinar and it will be uploaded along with the slides from today's presentation to our website within a week. Okay, so let's get started. So as you all know, on December 22nd, 2017, President Trump signed the Tax Cuts and Jobs Act. This new law is the largest overhaul of the tax code since the Tax Reform Act of '86 was passed. So today, Len and I are going to cover the following topics. Changes to the corporate tax rates and rate structure, various changes to the depreciation provisions, a new limitation on the deductibility of interest expense. There were some changes to NOLs. Len will take us through the business loss limitations, the qualified business income deduction, changes that were made to the deductibility of meals and entertainment, and then a bit on carried interest. So before we jump into our presentation, we have our first polling question. So as a reminder, if you need CPE or CLE credits, please answer the questions. So the question is, prior to the law change, what was the highest corporate tax rate? 25%, 35%, 15%, or 24%? So we'll give you another minute to respond. Okay, about 10 more seconds. Okay, so now the poll is closed. So the correct answer, the highest corporate tax rate, was 35%. So now we're going to get into the meat of the presentation. So prior to the passage of the Tax Cuts and Jobs Act, the corporate tax rates in the United States were one of the highest, if not the highest, in the world. This put corporations doing business in the states at an extreme competitive disadvantage. So like individuals, corporations are subject to tax under a graduated rate structure with rates that start at 15% and then scale all the way up to 35%. And the slide shows the different ranges of taxable income to which each of those rates applies. Keep in mind that right now we're only talking about C corporations. S corporations are not subject to an entity level tax. Additionally, if the corporation was considered a personal service corporation, they paid a flat tax of 35% on their taxable income. So a personal service corporation is a corporation whose principal activity is the provision of services substantially by employee owners that are in the fields of accounting, actuarial sciences, architecture, consulting, engineering, health, law, and even performing arts. So one of the cornerstones of the new legislation was the lowering of the corporate tax rates to make the U.S. more competitive in a global environment. So under the new laws, you can see, effective for tax years beginning after 12/31/17, corporations will now pay tax at a flat rate of 21%. So this is a substantial decrease in the corporate tax rate to a level that this country hasn't seen since about 1940. Additionally, the new rate also applies to those entities that are taxed as personal service corps. So now let's discuss corporate AMT. So again, like individuals, corporations were subject to the alternative minimum tax at a flat rate of 20% on their taxable AMT income above an exemption amount. The adjustments required to be made in calculating corporate AMT were similar to those required for individuals, so depreciation and things like that. Not all corporations, however, were subject to the AMT. There was an exception for small business corporations, and small business corporation is defined as a corporation whose average annual gross receipts for 3 prior years didn't exceed $7.5 million. Under the new law, unlike individuals, however, the corporate AMT has been completely repealed. So for for corporations who have AMT credits in existence as of 12/31/17, going forward, those credits will become refundable. So for tax years beginning after 12/31/17 and before 1/1/21, that minimum tax credit is refundable and can offset corporations' regular tax in an amount equal to 50% of the excess of the credit over the amount of the credit allowable. And that percentage jumps to 100% for tax years beginning in 2021. All right, dividends received deduction. Again, this deduction pertains only to C corporations. So this is a special deduction that's available to corporations who receive dividend distributions from other corporations in which they have an ownership interest. And the amount of the deduction is dictated based on their percentage ownership in that lower tier corporation. So as you can see on the slide, the old law permitted a corporation owning less than 20% of another corporation to deduct 70% of the dividends that it received. If the ownership was between 20 and 79%, then an 80% deduction was allowed. And for those corporations owning more than 80% of another corporation, they were entitled to deduct 100% of the dividends received from that lower tier corporation. Under the new law, the deduction stays, but the percentages are reduced. So ownership of less than 20% in another corporation yields a 50% deduction for dividends received. And then as you can see, if ownership is between 20 and 79%, instead of an 80% DRD, corporations will now get 65% DRD. And the 100% DRD stays provided ownership is greater than 80%. All right, so now let's talk about the changes in the depreciation provisions. So this portion of the presentation is applicable to all businesses, regardless of the entity type. So these rules will apply to C corporations, S corporations, partnerships, LLCs, and even sole proprietorships. So before getting into the new rules, I just want to talk a bit about what depreciation is and why these concepts are so important to so many businesses. So generally speaking, taxpayers must claim deductions in the year in which they are incurred or paid for. But as with every rule, there's exceptions, and the deductibility of the cost of fixed asset purchases is one of those exceptions. So the Internal Revenue Code has provided rules that tell us how taxpayers are able to recover the cost of those fixed assets. And instead of writing them off in year one, generally speaking, the IRS has provided useful lives for us within which we get to recover the cost of those fixed assets. So believe it or not, the useful lives that the IRS has prescribed generally don't always correlate to the actual useful life of those related assets. So as an example, a computer, we typically have to depreciate the cost of that computer over a 5-year period, whereas in reality, that computer has met the end of its useful life before the 5-year period expires. In contrast, the cost of a desk has a 7-year recovery period, when the reality is that desk will probably last a lot longer than 7 years. So as I said, every rule has its exceptions, and Code Section 179 provides one of those exceptions. So the general gist of Section 179 is that taxpayers can immediately expense up to a certain dollar amount of the cost of qualifying property that's placed in service by the end of a tax year. So prior to the passage of the new law, taxpayers could write off up to $510,000 of the cost of qualifying property placed in service. So keep in mind that even though the law changed, this threshold is still available for 2017 returns. It's also important to keep in mind that there's a clawback threshold of $2,030,000. So essentially this means that for every dollar that your qualifying purchases exceed this threshold, you lose $1 of Section 179 expense. So before getting into what types of property qualify, there's 2 other points I want to make. One is that in order to claim Section 179 expense, you have to have taxable income. So you cannot take Section 179 expense and create a tax loss. Additionally, this provision is electable. It's not mandatory. So in tax years where you would benefit from claiming this expense, you can certainly do it without locking yourself into the election for future years. So what's qualifying property? So it's basically any tangible personal property, whether new or used, with a recovery period of less than 20 years. So it essentially includes your computer equipment, your manufacturing equipment, your office furniture and fixtures. It also includes off-the-shelf computer software and certain qualified real property, which I'm going to get into in a few minutes. So under the new law, the 179 expense limitation has been increased to $1 million. So basically it's been doubled. Additionally, the clawback threshold that I mentioned earlier has been increased to $2.5 million. So this change is applicable for property that's placed in service in tax years that begin after 12/31/17. The key takeaway here is the term placed in service. So basically this means for any depreciation provision, whether it's 179, bonus depreciation, which I'm going to get into in a second, or regular depreciation, in order to claim the deduction, those assets have to be in use. They can't be sitting in boxes. They can't be waiting to be installed. Okay. Additionally, one of the most significant changes to this provision was the expansion of the types of realty that are eligible for this election. So historically, real property was never eligible for accelerated depreciation, and it was typically depreciated over very long lives, like 27.5 years or 39 years, depending on whether it was residential or non-residential. So now we can claim Section 179 on certain non-residential property. So basically, new roofs, HVAC systems, fire protection systems, alarm systems, and security systems that are installed on non-residential property are eligible for Section 179. This is really beneficial because, as I said, these types of property were typically depreciated over 39 years. So now let's talk about bonus depreciation. So bonus depreciation is yet another exception to that general depreciation rule. So under the old law, which is still applicable for 2017, bonus depreciation allows an immediate write-off of 50% of the cost of qualifying property that's placed in service by the end of the year. The remaining 50% gets depreciated under the regular depreciation rules, so using the IRS prescribed tables. On the surface, this seems to be pretty similar to Section 179. However, there are some very distinct differences between the two. First one is that under the old law, bonus can only be claimed on new property. And new in the sense that the original use of the property has to start with the taxpayer. Second, bonus depreciation is a mandatory provision, and you have to calculate your depreciation under the bonus provisions unless you make an election out. And lastly, bonus can be used in situations where there is a taxable loss, so you don't have that taxable income limitation that's imposed by Section 179. As for the types of property that are eligible for bonus depreciation, they're essentially the same as what qualified under Section 179, except for the realty portion. Bonus depreciation was only eligible on qualified improvement property, which is slightly different than qualified leasehold improvement property. So again, I'm going to discuss that in a minute. So under the new law, the bonus depreciation provision has been expanded to provide for the immediate full write-off of 100% of the cost of qualifying property that was placed in service. The interesting thing with this provision is its effective date. So it's applicable for property that was placed in service after September 27, 17. And because it's a temporary provision, we can only claim bonus depreciation for assets placed in service before 1/1/23. Additionally, they've lifted the requirement that the property be new. So now used property qualifies for bonus depreciation as well. And as I just said, the provision is temporary, and it's going to be completely repealed after 2026. But in the meantime, we'll get to enjoy the 100% write-off for 2018 through 2022. And then you can see it's phased down 80%, 60, 40, 20% for tax years between 2023 and 2026. Another caveat, a big one, however, in this provision is that it's not available for property that's used in a real property trade or business. So taxpayers owning rentals are not going to be able to take advantage of the immediate expensing. So now let's talk about the different types of real property that are eligible for these two provisions. Historically, real property, whether residential or non-residential, has been subject to depreciation over very long periods of time. So residential property has a 27.5-year recovery period, and non-residential property has a 39-year recovery period. There generally were no accelerated depreciation provisions allowed, and we have to use the straight line method for the real property. In recent years, however, as I mentioned a little while ago, for purposes of Section 179, qualifying property did include certain qualified leasehold improvements or qualified improvements that were made to retail or restaurant establishments. And for purposes of bonus depreciation, qualified improvement property was included. So under the Tax Cuts and Jobs Act, all of those separate definitions have been eliminated, and they're now rolled into one category, which is called qualified improvement property. A qualified improvement property is any improvement to an interior portion of non-residential real property that is placed in service after the building was first placed in service. Okay? It doesn't include enlargements, it doesn't include elevators or escalators, and it does not include improvements that are made to the internal structural framework of the building. So now any real property that meets this definition of qualified improvement property is eligible for depreciation over a much shortened 15-year recovery period. And that's using the straight line method. One other point related to real property, there's a concept known as ADS, or Alternative Depreciation System, which essentially extends the useful lives of certain, of all properties, basically. And realty has historically been 39 or 40 years. So what they did under the new law is they changed the ADS lives related to certain realty. So qualified improvement property now has an ADS life of 20 years. Residential property has an ADS life of 30 years, while under the regular rules, it's still recoverable over 27.5 years. And non-residential property, which I did not put up here, has an ADS recovery period of 40 years, while still being subject to a 39-year general depreciation period. And this will be relevant in a minute when I talk about the new limitation on interest expense. All right, so now let's chat a minute on the changes made to the limits, the depreciation limits on luxury autos. So as you all know, historically, there have been very strict limitations imposed on the depreciation of luxury autos. And I guess the thinking behind this provision is that it's not really necessary from a business standpoint to conduct your business while driving around, in a Lexus or a Lincoln, when you can probably accomplish the same thing, doing in a Honda. So in any event, as you can see on the slides, the annual depreciation for cars that are categorized as luxury autos has been increased. So now, instead of being stuck with $3,160 for the year placed in service, taxpayers can claim $10,000 in year one for luxury autos. Year two used to be $5,100, and it's going up to $16,000. There's $3,050 for year three. That's going up to $9,600, and the $1,875 for years 4 and later is increasing to $5,760. Additionally, there was a provision allowing $8,000 for bonus depreciation on a luxury auto, and that still stays in place. So that's $8,000. Okay, we're now up to our second polling question. The question is, what is the maximum Section 179 expense allowed under the new law? And remember, please answer this question in order to qualify for CPE and CLE. Okay, we're going to close this polling question now. Thank you very much. Okay, so now we're going to talk about the new limitation on the deductibility of business interest expense. So as with the depreciation provisions, these changes apply to all businesses regardless of the form. So again, regular corps, S corps, partnerships, LLCs, and sole proprietorships. So under the old law, interest paid or accrued by a taxpayer was generally deductible in full in calculating business taxable income. So there were some limitations in place, but we're not going to get into those. Under the new law, the deduction for business interest expense for any taxable year cannot exceed the sum of the business interest plus 30% of adjusted taxable income, which is essentially taxable income before depreciation, amortization, and the interest expense. To the extent that there's excess interest expense, that excess interest expense can be carried forward indefinitely, and it's treated as interest expense incurred in the subsequent year. So you'll be able to use it in your calculation of the limitation in those future years. Small businesses, including real estate trades or businesses, are not subject to this limitation, provided their average annual gross receipts for the 3 prior years does not exceed $25 million. There is a provision in the new law that does allow real estate businesses that are not classified as small businesses. So in other words, they are subject to this limitation. They can elect out of this provision if they use ADS depreciation. So the last point that I made in the depreciation section was this concept of ADS depreciation. So basically the trade-off here for these real estate trades or businesses is that they can extend the depreciable lives on their properties. Okay, in other words, claim less depreciation expense in exchange for not having a limitation on the deductibility of their business interest expense. So we've been talking about this internally, and I guess the takeaway is that real estate businesses are really going to have to sit down and evaluate whether or not, making this election makes sense. If the election is made, it is an irrevocable election. So before jumping into this, we really recommend doing, a full analysis of the costs and benefits related to making this election. So with regards to this limitation, it's important to note that it applies at the taxpayer level. So for C Corps, that's easy to determine. It's basically, the limitation is going to be computed at that corporate level in determining taxable income. However, when it comes to flow-through entities, as corporations, partnerships, LLCs, the taxpayer is actually the owner of that entity, right? Because those flow-through entities are not taxpayers themselves. However, the new rules apply at both the entity level and the individual owner level. So this slide lays out special rules that are applicable for partnerships and presumably S Corps and LLCs as well. And the gist of these rules is to prevent taxpayers from using the same income twice in determining the limitation for interest expense. So think about, a partner in a partnership. That partnership is going to calculate its taxable income, and it's going to have to calculate its own limitation on the business interest expense. So whatever interest expense is allowed to be deducted goes into the determination of its taxable income. Then the owners get K1s, and those K1s reflect, each of those partners' pro rata share of that income. So now the limitation for business interest deductibility has to be determined again at that individual level. So you're taking that partnership income, which is part of the individual's taxable income. So there's rules that are basically preventing that from happening. And they're really complex, so I just wanted to highlight their existence here. And, you can talk to us about any questions that you have related to this. Okay, so moving on to NOL deductions. So as a reminder, an NOL is the excess of business deductions over business income. So under the old law, taxpayers were allowed to carry their NOLs back to the 2 preceding tax years and claim any refunds of any tax paid. Additionally, there was a 20-year carry-forward period. There was no limitation on the amount of income that could be offset by an NOL. So enter the Tax Cuts and Jobs Act. So now businesses are only allowed to offset 80% of their taxable income with an NOL deduction. Additionally, the carryback provision is repealed, except for a special 1-year carryback that's allowed in the small business or farm context. Additionally, the carry forward period is now indefinite. So instead of having a 20-year carry forward period, they carry forward indefinitely. So this provision is effective for NOLs generated in tax years that end after 12/31/17. For those taxpayers that have NOLs that arose in tax years prior to 2018, those NOLs will continue to be subject to the old rules and limitations. And the last bullet point, NOLs that arise, starting tax year 2017 will grow by an interest factor to the extent that they're carried forward. I'm now going to turn this over to Len to take us through the remaining topics.
Thank you, Karen. So thank you everyone for joining us this afternoon. Hopefully it's been beneficial thus far. And I think, one thing we've seen, especially when it comes to the business provisions, and you'll see later this week if you join us on Thursday for the international provisions, is that a number of these law changes has really created additional complexity for business owners. So with that said, let's jump into a new business loss limitation. And historically we've had a few. There's 3 main ones that we've had in losses potentially being limited by cost basis or at-risk basis. Also, passive activity loss rules are designed to limit losses to taxpayers. Now we have an entirely new one to add to the pile of other loss limitations. So essentially what they're calling this is an excess business loss limitation. And this can be applicable to non-corporate taxpayers. So that's going to end up being your individuals or estates and trusts. And it's designed to capture potential losses from flow-through entities, whether it's a partnership, LLC, or S corporation, sole proprietorships, or Schedule E activities as well. So the new limitation is if you get past all the other loss limitations that are applicable for the year, you can't deduct a net business loss of more than $500,000 for married filing joint filers, or $250,000 for all other taxpayers. And what this is really designed to do is not allow you to offset wages or investment income with business losses any longer, or limit your ability to do so, I guess. If you have any excess business losses that are disallowed, they end up getting added to the taxpayer's net operating loss carryover and would be applicable to the same rules that Karen just discussed a few minutes ago. And in note for pass-through entities, this limitation is applied at the partner shareholder level, not at the individual entity level. So before we move forward, let's get polling question 3 done. Net business losses of a single individual taxpayer are subject to the following limitation: $500,000 A, B, $250,000, C, no losses are limited, or D, net losses are not deductible. So we'll open this for a few minutes. Reminder that if you need CPE or CLE credit, please do answer this question. Okay, we're going to go ahead and close that polling question. The answer is B, $250,000, because it's a single individual taxpayer. Reminder that the $500,000 limitation only applies to married filing joint filers. So this is where it gets really complicated in my mind. It's the new deduction for qualified business income. So this is going to be available to all non-corporate taxpayers, still sticking with the same individuals, estates, and trusts. And the deduction is up to 20% of qualified business income, which must come from a qualified trade or business. Seems simple enough so far. But let's get into a little bit of the complexity. What qualifies any trade or business other than specified service trades or businesses and performing services as an employee? So I'm just going to go ahead and read what specified service trades or businesses are just so that I don't miss any. But it's any in healthcare, law, accounting, actuarial science, consulting, performance arts, financial services, brokerage services. Any trade or business where the principal asset is a reputation or skill of one or more of its employee owners, or any trade or business which involves performance of services that consist of investing and investment management. So the two that are clearly not included in here or statutorily written out of being subject to this limitation are engineers and architects, two that are very friendly to the real estate industry. And when I read this definition of what is a specified service trade or business, it's really written in a way when you consider that consulting is included, and also any business where the principal asset is the reputation or skill of one or more of its employees or owners. It's really designed to capture most service businesses. Hopefully we get some level of regulations that give a better definition of some of these terms, and perhaps we'll even give some guidance as to what types of service businesses would not be included in a specified service trade or business. And then that brings us down to real estate. What about real estate? You're going to see in a few slides, based when we talk about one of the limitations, that clearly, it's intended to apply to some real estate businesses. And the thing that you have to take a look at when it comes to real estate is, does the real estate activity rise to the level of a trade or business? Is it being carried on a regular basis for profit? So I think an example where you have an apartment complex where you're performing services for the renters, you clearly have a trade or business, and this would be applicable to those. Where you get a little murky is what if you get to a triple net lease type of arrangement where the owner of the real estate really isn't doing much other than maybe paying some real estate taxes and mortgage interest. So keep that in mind. We're going to have to hopefully get some regulatory guidance from the IRS, and I think our hope and our expectation is that it'll be somewhat similar to what we got for the net investment income tax, which is if you're a real estate professional and you've made an election to group all of your activities together, all of your real estate activities would therefore be considered a trade or business. But we're going to have to wait and see what we get from the IRS in terms of more guidance. So there's an exception for small service businesses. So even if you were, met that definition of being a specified service business, the limitation wouldn't apply to you if you meet certain income thresholds. So you could still claim this deduction. And it's for taxpayers that do not exceed the threshold amount plus $50,000 or $100,000 if you're married filing joint. And the threshold amounts are $157,500 for most taxpayers, $315,000 for married filing joint. So if your taxable income is less than either of those numbers, whether you're married filing joint or other taxpayers, there is no limitation on your ability to take this deduction. If you exceed the $157,500 by a number less than $50,000, it's going to be subject to a proportional phase out of the deduction. Same for $100,000 for a married filing joint individual or couple. And I guess one thing that I got a kick out when I was reading the law is that they're now calling this phase out a phase in. First time I've heard this term, and I think it's just a more politically friendly way to say that we're taking something away from you. If they say as a phase in, maybe the taxpayers will think they're actually getting something here. And these amounts are scheduled to be indexed for inflation after 2018. So what is qualified business income? It's going to be the net amount of all of your income, gain, deductions, and losses relating to any qualified business. And just keep in mind that qualifying businesses have to be U.S. entities or doing business within the U.S. Items not considered to be qualified are going to be any investment income, any reasonable compensation paid to owners of a shareholders of a corporation, or guarantee payments to the owner of a partnership or LLC. And they've also specifically carved out publicly traded partnerships, but you'll see that they're going to come back into the equation or calculation in a slide or so. One thing to keep in mind is that the IRS may actually try to reclassify some business profits for partnerships and S-corps to comp, whether it's a guaranteed payment or reasonable compensation, to try to limit this deduction that's available to taxpayers if they feel that you're not paying the owners enough or compensating the owners enough for the services they are providing. So the qualified business income amount, which will end up being what the net deduction is once we go through a number of phase outs. But the deduction is limited to the lesser of 20% of the taxpayer's qualified business income for the year, which we just discussed on the last slide, or the greater of 50% of W-2 wages for the qualified trader business, or, and this is where real estate comes into play, the sum of 25% of the W-2 wages plus 2.5% of the unadjusted basis of qualified property. And just stick with us for a second. I'm going to go through some of these definitions, which are new terms, on the next slide. Once you figure out what the lesser of these two calculations are, you're going to add to it 20% of qualified REIT dividends and publicly traded partnership income. Keep in mind that if you have a qualified business that's running at a loss, you would actually end up with a negative qualified business income amount, which would offset any positive deduction amounts that are being calculated for profitable businesses. And the other important thing here is that the deduction is calculated for each trader business of the taxpayer. The terminology used within the code suggests that everything is done on a separate business basis. You wouldn't aggregate these items. So quickly going through some of the definitions, qualified property is going to be depreciable property held for the production of income for which the depreciable period has not ended. For any assets with a recovery period of 10 years or less, that's going to be the depreciable period is going to be defined to be 10 years. So whether it has a useful life of 3 years, 5 years, 7, or 10 years, you're automatically going to get to use that for 10 years. And for any property beyond that, it's going to be whatever the depreciable life is or whatever the class life is for that asset. And keep in mind that it's going to be based on the original cost basis of these assets and not the net basis after depreciation. Qualified REIT dividends, which are dividends from a real estate investment trust, are going to be any dividends that are not subject to preferential capital gains or qualified dividend rates. So this is going to be just for ordinary dividends that don't get any special treatment that would otherwise be subject to ordinary income rates. And then qualified PTP income is going to be qualified business income of a publicly traded partnership, plus any ordinary gain that's recognized on the sale of the PTP. So, because this is all pretty complicated, I did want to get an example in here. So a taxpayer, an individual, owns a furniture manufacturing business, which has $2 million of net business income, paid $600,000 of wages during the year, and has $5 million of qualified property. So what is the taxpayer's qualified business income amount for the year? So let's go through the calculation. Start with the lesser of 20% of $2 million, which is $400,000, or the greater of 50% of wages. So 50% of 600 is 300,000, or 25% of wages. So 25% of 600 is 150,000 plus 2.5% of the original cost basis of the assets, or 5 million, which is calculated to be 125,000, for a total of 275,000. So the greater of A or B works out to 300, and then you look to what is the lesser of 1 or 2, which also ends up being the $300,000 amount. So your qualified business income amount, your maximum potential deduction from this business, works out to be $300,000 for the year. So there is an exception to the wage limitation, and this exception to the wage limitation is the same exact limitation that applies for determining whether or not you can exclude a service company from this. So taxpayers' income who does not exceed the threshold amount, 157.5 or 315, plus the phase-in amounts of 50,000 or 100, would be able to take advantage of this, even if you have not paid any wages. You can completely exclude that bullet 2 from the last slide, which is the wage limitation, and just be subject to the 20% limitation. So get us on to our next limitation after we've gone through the wage limitation or qualified property limitation, and we now have a taxable income limitation. So the deduction is going to be the lesser of the combined qualified business income amounts, or whatever the net deduction is from all trades or businesses, or 20% of the excess taxable income over net capital gain. So essentially they're backing out net capital gain from this calculation, plus the lesser of 20% of qualified cooperative dividends or taxable income. So an example for this taxable income limitation, individual A has a qualified business income amount of $100,000 and taxable income of $800,000, which includes $400,000 of long-term cap gains. Also assume that this individual does not have any cooperative dividends, so that second leg of the test would be 0. What is individual A's qualified business income deduction for the year? So the deduction would be the lesser of the $100,000 calculated amount, or 25% or 20% of adjusted taxable income. So you take the $800,000 of taxable income, backing out the long-term capital gain of $400,000, multiplied by 20%, and the cap is 80%. So for this taxpayer, even though they've had a qualifying business income deduction of $100,000, it gets capped at 80% based on their taxable income amount. So meals and entertainment. So we've made the tax code, and Congress has made a number of changes to how we're going to be able to deduct meals and entertainment for businesses going forward. And these are all going to be effective as of January 1st, 2016. One is that what was otherwise a 100% deduction, which was employer-provided meals, are now going to be subject to a 50% limitation. And these are going to be applicable for any food and beverage expenses provided to employees at an employer-operated eating facility, or meals furnished to the employees on the employer's premises for the convenience of the employer. Effective January 1st, 2016, these food and beverage expenses are going to become completely non-deductible. Entertainment expenses are going to no longer be deductible effective January 1st, 2018 as well, with a few exceptions that we'll discuss in a moment. These types of expenses include any activity considered to be entertainment, amusement, or recreation. Also, membership dues for any club organized for business, pleasure, recreation, or social purposes. Please keep in mind that these are only for clubs organized for these purposes. It wouldn't be applicable to, say, a chamber of commerce or business league or trade types of organizations. Those types of dues are still expected to be deductible. And then also any charges for a facility used in connection with providing either of the above entertainment expenses. I'm going to come back to that polling question in just a second. I think I snuck it in there before the right slide. Entertainment expense limitations does not apply to expenses for recreational, social, or similar activities primarily for the benefit of employees. So this is going to be holiday parties, summer outings, other types of recreational activities designed for team building, or just for the employee benefits as a reward. Also is not going to be applicable to business meetings for employees, stockholders, or agents or directors. And any expenses directly related to the attendance of business meetings or conventions of business league organizations will also continue to be 100% deductible. So practically speaking, what businesses are probably going to want to do going forward to proactively deal with this is almost create three separate meals and entertainment expenses in their chart of accounts. one to try to capture all the 100% deductible items, one to capture the 50% deductible items, and one to capture the entertainment expenses that can no longer be deducted. I know historically a lot of businesses have tried to keep this in one account, but now it's going to need to do some more. They're going to have to do some more digging and some more thought in how to categorize these, and it'll be much easier to do as they go along throughout the year rather than try to do this at tax time. So let's go to the next polling question number 4, which is our final polling question. Which of the following entertainment expenses would not be deductible? Lunch meeting at a Chamber of Commerce, A. Golf with a client, B. Holiday party for employee, C. Or D, cost of a board of directors meeting. Reminder to please answer this if you are seeking CPE or CLE credit. Okay, we're going to close that polling question. So B, golf with a client would no longer be deductible. As much as I enjoy playing golf, I guess I'll have to find another way to entertain or to meet with some of my clients. So final topic of the day, and then we'll try to get to a few of the questions or just have a bigger discussion on some of these issues, is going to be for carried interest. And this is one that received a lot of publicity during the presidential race between President Trump and presidential nominee Hillary Clinton, was how are they going to close the loophole for carried interest, where the promoters of these investment vehicles were being compensated for their services by being allocated long-term capital gain income and getting favorable rates compared to other service providers who were subject to ordinary income tax rates. So I think what they ended up doing here was more of a compromise. It wasn't quite as aggressive as I thought they would be on carried interests. And these carried interests are going to apply to partnership profits interests held in connection with the performance of services. And it's going to apply to partnership interest holding specific assets such as securities and commodities, which you would expect, but also they're going to apply it to real estate entities held for rental or investment. So if you have a promoter of a real estate entity who's getting a profits interest, you're also going to have to pay attention to these rules. And essentially what it does is it reclassifies long-term capital gains allocated to a profits interest holder to be treated as short-term capital gains. There is one exception that if the gains are if the underlying gains that are being created are held for more than 3 years, they would not be subject to reclassification. So they've essentially, for these carried interest holders, they've redefined what a long-term capital gain is from greater than 1 year to be greater than 3 years, effectively. So they're really for longer-term investments. Now, I said it's a little bit of a compromise because although short-term capital gains do get taxed at ordinary income tax rates, you may be able to free up some otherwise limited capital losses that the taxpayer may have to offset some of these. So it's not being treated as harshly as compensation would, but if you have a net short-term capital gain after considering any capital losses for the year or capital loss carryovers coming into the year, they would be taxed at ordinary income tax rates unless the underlying assets were held for more than 3 years. So that brings us to the conclusion of the topics for today. So why don't we answer a question or two, and maybe we'll have a little more discussion in the last 5 or 10 minutes.
So one of the questions that popped up is, what's our interpretation of reasonable compensation for a service business? And I think while that concept isn't really defined anywhere, anytime that we speak with our clients about reasonable compensation, we're generally, the bar that we're using is, what would you have to go out into the marketplace and pay somebody to come in and, if you had to replace the individual that you were trying to determine reasonable comp for. So again, I think that's, we've predominantly seen that in the context of S corporations, where we were taking historically low salaries in order to avoid the payroll taxes on that S-Corp shareholder salary, because the K-1 income from the S-Corps is not subject to those payroll type taxes. So, a lot of case law came out basically, putting in place this reasonable comp standard, yet they didn't really define it anywhere. So I think, it's probably prudent to use that, external hire concept when trying to determine reasonable comp. Another question that came in related to where on the 1040 is that 20% qualified business income deduction going to be reflected?
That is currently a mystery, unfortunately. We're going to have to wait for the IRS to prepare some draft tax forms for next year. I think perhaps we get something similar to how the domestic production activity deduction was treated, where it gets calculated on its own separate form and then rolls into the 1040, but they haven't provided us any guidance with how they're exactly going to handle that yet. But I do suspect we will have a unique form to do the calculation, and then they will pick a line item in order to deduct that from taxable income.
I had actually read somewhere commentary, I don't know if it was in the committee reports or somewhere, that they were talking about possibly putting a line at the top of page 2 of the 1040, because this deduction is not allowed in determining AGI, but it's not an itemized deduction either. So it's got to be somewhere in between the two.
Right, and I think when we're talking about a lot of these laws, there's still a lot of unknown, because in some areas the code, the Internal Revenue Code, is a little gray and doesn't give a lot of specifics. So we are going to have to wait for some tax regulations to be written, and hopefully we have those by mid-year so we can start to get our arms around them and get some better definitions in place on how to deal with some of these new tax ramifications or tax provisions.
There are a couple of questions about whether or not the slides were going to be made available. And as I said in the beginning, when the webinar recording is uploaded to our website, we will make the slides available as well. That's basically all of the questions that have come in that I think would impact a broad base of you listening. So the new, this last question that just popped up, the new act will apply to 2017 tax returns. No, for the most part, unless there were specific effective dates, bonus depreciation being one of them, all of these provisions are effective for tax years beginning after 12/31/17. Okay, so 2017 tax returns are going to be computed using the old rules. Okay. I don't know if there's anything else on any of the topics, Len, that you wanted to go back and maybe expand on.
No, I don't think so. I think we're in pretty good shape here. I think this year is one where we're going to have to pay attention and start doing a little bit of planning earlier so that we make sure that we're prepared for some of these changes well in advance, and make sure we're doing things sooner rather than later. As soon as we do get some level of tax regulations, because like I said, we're still dealing with a lot of unknowns, and there may be some adjustments we can make to some of these businesses to be able to take advantage of some of these.
Okay.
So upcoming, keep an eye out for our future webinars, one of which is this Thursday at 10 a.m. That's going to focus on the international tax provisions of the Tax Act. And in a couple of weeks, on Thursday, January 25th at noon, we're going to be discussing the tax changes impacting the real estate industry.
Okay. Thank you all for joining us, and we look forward to your participation in future events. Have a good day.